Good afternoon, everybody, and welcome to our latest edition of our Top 3 series of webinars. My name is Carl Capalingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we investigate, this time around, the top 3, but wait, top 4 ASX Turnaround Stocks. In doing the analysis, obviously, there's dozens of potential stocks there, but I couldn't narrow it down from 4 to 3, so I went with the 4. Before we talk about that, of course, we'll talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with Think Markets. And here's 5 more for new clients who sign up before June 30. There are a few other T's and C's, of course. Check the website for details, but another 5 good reasons to make sure your next ASX share trade is with us. The agenda for today. And if you obviously, when you registered, you would have seen this little blurb up there, which I put up from one of my favourite movies, Wall Street, and it's from one of the main protagonists in the movie, Gordon Gekko, who labels a particular stock a dog with fleas. And the stocks we're going to discuss today, all 4 of them could well be described as dogs with fleas. But there's also another saying, and that is that every dog has its day. And the question is today that day for the 4 stocks we're going to review? Is a bit of a spoiler? Probably not, given how bad the market is today. But all 4 stocks are moving closer and deeper into that value zone potentially. Okay, so first we'll talk about the selection process. So what do I consider to be a turnaround stock in the first place, and what are some of the reasons why it has become that way? And then we'll look at the 4 stocks. So without further ado, A2 Milk, Appen, Kogan, and Treasury Wine Estates. 4 of the stocks I get asked about the most, really, in my role here at Think Markets. Are they cheap enough yet to buy, Carl? Because all 4 stocks have had a significant pullback in their share price. Generally, it's been caused by an extraneous shock. So extraneous means external to the business, something the business really couldn't foresee or control. For example, a global pandemic like the one we had. Certainly it's had a big impact on A2 Milk, for example. Chinese tariffs on Treasury Wine Estates. Not much they could have done about that. And generally, that event triggers a negative share price index. Many of these stocks down 50, 60% from their all-time highs. We're going to talk about, obviously, the selection process, why they've fallen so far from their highs, but just looking at how far some of these stocks that we're going to talk about have fallen. So A2 Milk down 61% from its high, Appen down 64%, Kogan down 49%, and Treasury Wine Estates down 48% from its high. Not insignificant falls. We talked about them obviously dealing with these extraneous shocks to their earnings. We'll talk about what each of those shocks are, how the businesses are pivoting to respond to those shocks. Are there any prospects for a return to growth? And is there any long-term value still in the business? Is the stock potentially undervalued? Okay, here's the trick though. Big price fall does not necessarily equal a big price recovery. Some stocks go down and they never come back. So there's this concept we talk about in the markets of a value trap. Certainly something has fallen a lot. It might even still have, when you're looking at, say, its last year's earnings, have a pretty reasonable PE. But markets look forwards, not backwards. And sure, that PE might be 10 times last year's earnings, but next year's earnings are expected to be half of last year's earnings. So in actual fact, the PE is not 10, but it's 20, because you're halving the E, and therefore the ratio doubles. I think it's very sensible to understand the risk in these types of trades. So as many of you know, I'm more of a technical analyst. I do like to follow my trends. I like to see charts that are bottom left, top right. Ideally, that indicates that markets are paying more and more for the growth that they're seeing in the business. They're, in my opinion, whilst the prices have gone up, not down, they're lower risk plays. in many of these cases, the prices are going down for very good reasons, and therefore the risks are high. And I do think you need to take a longer-term time horizon. So if you're a shorter-term trader, you like to trade 5-minute, 10-minute hourly charts, this is probably not the webinar for you. And then, just because we think we've found a buy point doesn't mean that they're necessarily out of the woods. So these sorts of investments are a little bit more labour intensive because they do require regular monitoring and reassessment of whether the reasons for the turnaround are still in place. I think a great thing about technical analysis is we can basically offload a lot of that work by simply looking at the chart, because we know that there are analysts out there like me doing this research on a day-to-day basis and coming to that conclusion based upon those fundamentals. They tell their dealing desk, hey, this is a turnaround play, it's time to buy this. The dealing desk go out and buy, they become part of demand. If some of that stock is already in a particular fund, they stop selling it. That's the other part of the equation. So not only does the dealing desk start buying, the dealing desk stops selling any holdings they had. So you get an increase in demand, a decrease in supply, and that shows up in the chart. And that's what we're going to look for. So we'll take the angle as well. How do I spot these turnarounds on the charts, not just the fundamentals? And with respect to the previous slide, I should have said, is the price in a short-term uptrend? Is the price in a long-term uptrend? Is the price near an opportune entry point? We may need to wait a period of time before that is going to occur. So part of the process is identifying whether a stock is cheap on a fundamental basis and then potentially waiting until it starts to look good on a technical basis, and therefore a patient approach may be required. Okay, first stock we're going to look at today is A2 Milk. It's one of the most popular stocks on the market, not only because it really did perform so well on the upside, but it's had a similarly spectacular collapse. Probably all know what they do, and you can see the little ad playing in the bottom corner there. But there's two major parts of the business. So production of fresh milk that contains just the A2 protein. And if you believe the rhetoric and hype from the company, this can help those who have various intolerances to milk, and also potentially reduce the incidence of heart disease and other health problems. There's no scientific evidence to actually prove that this is the case, but that, hey, why let the facts get in the way of a good marketing message? And certainly they have done very well. They have, up to this point, captured about 11.8% of the Australian fresh milk market, starting from zero, of course. And they've got 30% of the Australian infant formula market and about 2.5% of what is a massive, massive Chinese infant formula market. What was the problem? What was the extraneous shock to the business? Well, the COVID-19 panic, which was a similar devastating shock to many businesses out there, in particular hurt A2 Milk because of the impact on movement of people between China and Australia. Obviously, lockdowns locally here impacted various businesses that were in the business of purchasing Australian labelled infant formula and then selling it into the Chinese market, either by physically transporting it there or through online sales. So it was a well-worn side gig for a lot of Chinese students who would come here to study. They'd go down to the local Woolworths or Coles, buy a bunch of this milk, and then sell it through their various channels back into China. We also had some corporate lockdowns that impacted some of the companies that do that business as well. So we saw English label infant formula sales fall by 41% in the last financial year, and there was also an increase in costs and just focus by management on this problem due to higher inventories and what they were going to do with that. Another reason for the fall, which is probably less publicised, is the fact they own 20% of Synlait, which is another milk products company, ticker code SM1, and that company has fallen a fair bit as well, so a bit of a hit on the value of that investment. Looking forward, how are they dealing with it? Well, there's not a lot of information from the company, and I obviously follow the company reports as they come out, and any announcement that the company makes, and it's kind of conspicuously lacking in detail on how they're going to deal with it. Now, they use these fancy really marketing terms like rebalance inventories. I'm not really even sure what that means. They've got all this stuff and they've got to sell it some other way, I guess. Providing temporary support to Daigou resellers. No real details on how they're doing that. Incentivise corporate Daigou, again, it's all pretty wishy-washy stuff, investing in e-commerce capability. And that's an interesting one as well, because obviously if Chinese students can't take 10 cases in their luggage, then maybe that's some impact. So the ability to sell it directly into China. So it's a little bit concerning that there's not a lot of strategies on how they can deal with it, but I think, as I'm going to say in a couple of slides' time, there's not really a whole lot they can do with it anyway. All right, it's kind of circumstances outside of their control. On the flip side, and on the plus side, I mean, there is a good business outside of this Daigou trade, and the China label, which is the same stuff, but it's just got a Chinese label on it, which they sell into China, actually rose by 45%, but it's off a much smaller base. You might say, okay, well, I'll just go back a slide. English label infant formula sales fell 41%, China label sales were up 45%. Doesn't one therefore balance out the other? And it's not the case, because one was coming off a much larger base, and that is the English label sales, which is the bulk of obviously that segment of the business, and China label sales are still very small at this point. But they are increasing their store footprint. That is, they're selling it in more stores over there, and their market share is growing, and it's only at 2.4%. So it gives you an idea of some of the potential growth that they can have in that market. Fresh milk sales did pretty well last financial year, up 16.3%, and in the USA, where they're a very, very new entrant, and it's still a very small part of the underlying EBITDA, it was up 22%, but again, growing their sales and growing their exposure in various supermarkets. The only other problem, and this is one of the key problems for the business more generally, is that margins up until COVID were increasing because they had this great point of difference and this great marketing campaign around it, with lots of beautiful young people drinking their lovely milk. But COVID has caused, particularly in the US, many consumers to not want to pay such a premium for these types of products. So that has had a direct impact on their margins going forward. We can see margins were down just over 8% to 28%. So previously, one of the reasons why you invested in A2 Milk was because of the fantastic and growing margins they had, and that's just not the case anymore. I think this is one of the key reasons for the market downgrading the stock. But otherwise, the numbers weren't fantastic. Revenue down overall, 16%. Underlying EBITDA, which is earnings before interest, tax, depreciation, and amortisation, down 32%. And importantly, operating cash flows down 106%. And that was on the back of lower cash receipts and higher costs. Never want to see that in a business, and high interest payments as well, because there's a little bit of debt in the business. Interim dividend was zero. The company's never paid a dividend anyway, so that was probably no surprise given what was going on with COVID. So if you're looking at this one as a potential income investor, it's probably not for you anyway. In terms of their guidance going forward, they did issue some guidance, which is great for us as analysts, because we get to start to make predictions on value. And they said that revenue would probably fall another 11%, and their margins were going to continue to fall. But that, again, I mean, it doesn't sound great, but there was a line in there which was quite conspicuous for me, which says it assumes the reactivation of Daigou channels, and that reactivation would deliver a significant improvement. And I just can't see that happening. And there's probably in the green on each one of these stocks, there'll be a quote which I thought was quite interesting from their last financial statements. It says there, from the company, the pace of recovery in the Daigou reseller channel has been slower than previously anticipated, and the company now expects revenue to be at the lower end of previous guidance range. A lower EBITDA margin is also expected. So this is the important bit: combination of lower revenues, lower profits, lower margins, and they'll struggle to kickstart those in the very near term. Further out, once we've dealt with this COVID issue, there's a free flow of people and commerce again through Australia and China, and there's some question marks over how cranky China's going to get over some of our other products. We know what's happened to Treasury wine estates. We'll talk about that later. So there are still some risks there as well. But longer term, that channel will reactivate, but it's just a question of how long you can wait until it does. Having a look at some of the financials, you can see the spectacular performance. Spectacular. It is fantastic performance. I mean, that is just amazing growth, and hence the share price performed in a very similar way. It doesn't look like a big dip here, but I think the market was expecting something more along these lines, and the reality is probably more along these lines. So the valuation and the multiples investors are prepared to pay for the earnings ultimately will have to change. Again, EBITDA you can see there's a big tectonic shift in the 2021 period there, and free cash flow. This is probably a key for the business under threat at the moment. Dividends per share, and these are Thomson Reuters forecasts, by the way, so they aggregate a number of the biggest brokers and their various forecasts together. We're expecting a 5 cent dividend to come in FY23, but who knows. Having a look at some of the valuation metrics, so enterprise value to revenue is something we like to look at more for companies that maybe don't have profits, and it's just a way to compare companies that don't have profits yet, but nonetheless, it's still always interesting to look at. It is not too bad there at 3 times earnings. Price to cash flow is not fantastic at 20 times earnings. We want to see that probably half that, and probably the same on enterprise value to revenue. Price to earnings ratio at the moment is, and it depends on how far you want to look out, but sort of 20 a couple of years down the track, and then mid-20s and high 20s for next year's earnings. And they just appear too high for me for what they're going to achieve. So high PEs are not a problem necessarily if you've got great growth to back it up. So if you've got a PE ratio of 10 and you're growing your earnings at say 100%, that PE for next year is going to be 5, and then the year after that is going to be 2.5. So today's PE is not as important as what the growth rate is, and there's no growth in the business. So that's the problem. I would even challenge whether these PEs are going to dip over time. Return on equity was excellent. It was one of the best in the market, but it actually, the brokers aren't thinking it's going to be too bad going forward. Just in terms of that broker consensus, so this is not what I'm thinking about the stock, but what the brokers are thinking about the stock. We do have at the moment one strong buy, one buy, 3 holds, 3 sells. That's a bit concerning for me. So, and 1 strong sell. So four big research houses have done the maths and said, look, even at current prices where we want to sell it. The last price I've used is just was at 9 o'clock. My time, as I'm in Perth, 11 o'clock your time if you're on the east coast, of 7.77, and based upon the mean target of the brokers, that provides about 18% upside. There are 10 estimates in the system at Thomson Reuters. The highest estimate is 13.20, the lowest is 6.71, and a standard deviation in those estimates is $1.79. Just explaining what's on screen, but I guess what we're more interested in is how much is left in terms of upside and what the rating is. So brokers are thinking, on average, the stock is probably a little undervalued, but these targets are always prone to revision. Having a look at the technical analysis, so we've kind of investigated some of the dynamics around the A2 milk business, what they could do going forward. My opinion is that we're going to see lower growth, we're going to see lower margins going forward, and it kind of explains why the chart looks like this. I can't be a buyer until I see some evidence of a change in this long-term trend, or at the very least, a move back into a short-term uptrend. And the legend for what the various colours mean are on the bottom left-hand side there. The candles are predominantly black, which tells us even if the market opened up on a particular day, so thinking about the broader market here, there's enthusiasm we know in the broader market, the ASX 200 is going up, so A2 milk opens up because the rest of the market's up, but by the end of the day, the broader market's still up and A2 milk has been beaten down, hence the black candle. It tells you that the big fund managers are looking to sell into any strength they can find on this stock, looking to sell into anything that resembles good news and a blip up. And it just keeps getting hit and hit. And far from being a buy, the only thing I can see in this price chart is further downside. And I'm happy to be corrected by the market if the stock starts its tremendous rally tomorrow. But I just can't see evidence of that in the chart for now. This is the weekly chart, so we've gone from the daily chart to the weekly chart now because I can't really zoom out in the PowerPoint slide to give you some perspective on where this could go. It's looking a little bit ominous here, because if it does break the 768 level, we're into this area here, sort of around 7 to 750, where there was some support in the past, and then failing that, there's really not a lot holding it up from there. So it's a bit of a crucial level. I wouldn't say all is lost, but if it starts to get to below 7, then it's looking very, very shaky indeed. Okay, let's wrap up A2 Milk with the conclusion. So based upon the theme of today, which is the stock a dog with fleas? And I had to think about this one a little bit. I've gone no, because the fresh milk business is a good one. It's growing its market share, and the opportunity for the China branded infant milk formula I think is substantial. So no, I don't think it's a dog with fleas. I just think it's overvalued, even though it's fallen over 60% from its highs. Daigou is going to be hard to jumpstart. The delay due to the pandemic, it's not going to be months, it's going to be years until I think we get back to normal and we have vaccine passports and the like. And who's to say there isn't going to be some other issues in terms of different strains of the virus and other restrictions or lockdowns that could occur because of that. But as I said, look, the rest of the business is solid, and the growth from that part of the business is impressive. But because the Daigou channel was such a big chunk of change, overall we're probably not going to see growth for a while. Because the Daigou channel was so profitable, margins will have to adjust, and that was the real reason why you were buying this business in the past, margins and growth. If it's not there, then the multiples are going to contract accordingly. By multiples, I mean investors, big fund managers might have been happy to pay 20 or 30 times earnings for this stock, but if it's just a milk stock, why would you do that? You probably want to be buying this more around a PE of 15, not 30 or 10 even. So based upon that, and looking not at next year's earnings, but giving this a bit of a chance and looking a couple of years out, I've got some valuations for you. So I think the stock, which is currently trading at 777 as of 11 a.m. this morning, I think it's good value between sort of 510 and 680, which would put it really at the bottom end of that support zone on the chart that we saw. I think it's great value between 340 and 510, and I think it's a bargain below 340. So if you've got A2 Milk, I'm not thinking it's a bargain until it gets to 340. If you're looking to buy, the chart would suggest that there's still some time to go. So is it a buy? The answer is no. Okay, moving along, because I'm just worried about time here. Welcome to everybody who's joined me since I started the presentation. The next one is Appen, which is an information technology stock primarily in the business of analysing data sets to train computers on how to think. And really, the goal is to train the computer on how to analyse the data set itself. Therefore, the first point there is machine learning, but the sub sort of sectors of that machine learning are image recognition. We said a little graphic going on screen there, where an Appen employee and Appen's employees are really crowdsourced. So they've got over 1 million part-time employees that work all over the world doing exactly what we can see right now. So Appen has the platform. Appen will give them a portfolio of images that they need to analyse on a particular day, or they get paid per image, for example. And they do exactly what you can see on screen. They're highlighting what is a car, what is a tram, what is a person, what is a stop sign. Okay, and they will do that thousands, collectively millions and billions of times. When you think about how many images an individual might analyse, and there's over a million of them around the world. And the goal, therefore, is to tell the computer, this is what a car looks like. So next time you see this shape, know that it's a car. Okay, why is that important? Well, it might be important in self-driving cars, for example, which we know is going to be a major growth area going forward. Might be important for Facebook, analysing all the images that get uploaded to Facebook to see if there's some sort of trend there that Facebook can use to make more money. But they also do speech and audio recognition as well, and that can, similar sorts of thing, help with bots that speak to you. So this is a major thing in customer service. We're going to find that we won't be speaking to real people. We'll probably be speaking to bots that know how to talk back to us and say all the right things that we need to hear. So it is high-tech stuff, and they are the biggest and the best at it. So it's a fantastic Australian success story in that regard. They are the world's largest provider right now of human-assisted learning data. They service 8 of the top 10 tech companies in the world, even though they won't tell us exactly who those are, but you can use your imagination to think about who they are. We talked about search engines as well, so words that get typed in, looking for patterns in that, and how do you use that to provide better search results. Even if you're a company who has an online website and you want to provide a search box, so when the user is typing in a term, how do you give them the best results? Social media, we talked about, e-commerce, cybersecurity, so identifying people through face recognition. Autonomous vehicles, manufacturing. You think about a machine in a factory that needs to identify a particular circuit board and what a circuit board looks like, or what a computer chip looks like, to install it onto a circuit board. Healthcare, so medical imaging, for example, and then I've gone etc., etc., etc. on purpose, because it's not a case of which sectors in commerce, in the economy, it's not a case of which sectors are using artificial intelligence. You've got to think about, well, which sectors don't use artificial intelligence, or which sectors aren't going to use artificial intelligence in 10 years. The answer is probably none. So it gives you an idea of the scope of this business and what these guys provide. Okay, problems. What's caused their big pullback in the price? And as we saw at the start of the presentation, just over 60%. COVID-19 has certainly been a major factor. It has caused a number of companies, just broadly speaking, to defer and reprioritise projects. So they're focusing on their core business rather than necessarily improving their artificial intelligence offering, creating that customer service bot. That was a 3-year project that they were using Appen to help them out with. And that's understandable, and there's also been more generally reduced spend on advertising, which has hurt some of their search business. Increasing competition. They're not the only company in the world that does this. There is one listed on the NASDAQ in particular that is a key competitor. The name escapes me right now, but yeah, there are other options in the space. And they're probably the other thing that's hurting them a little bit is a little bit of a loss of faith in the model potentially, because Appen has promised a lot in terms of the money they spent on research and development into moving away from this crowdsourced model where they've got human beings, which are expensive, let's face it, and make mistakes, to the machines learning how to do the analysis themselves. And they've taken some steps towards that, but it hasn't occurred to the degree that the market was hoping. And that the upshot of that will be the flow through to margin. So obviously, if you can replace those 1 million human beings with a single supercomputer, you're going to save a whole heap of money. And whilst Appen's revenues have grown, margins haven't grown accordingly. Okay, outlook going forward. I think the outlook is actually quite good. The AI industry itself is growing. We're expecting sort of mid-20s compound annual growth until 2030. We've talked about autonomous vehicles and things like that. We've talked about, hey, what industry isn't going to use this stuff? They've got a big exposure in the US. We know the US is taking a big hit on COVID, but we equally know that some of the data now is showing that the US economy is bouncing back strongly. So I don't think all is lost for Appen. On the contrary, I think potentially they can move back to some of the spectacular growth that we've seen in previous years. Looking at the FY20 results, and straight away you can see a compare and contrast between these results and the A2 Milk results, because revenue was still up, even though they've had all these problems due to COVID, and that speaks to the strength and the growth within the business. Underlying EBITDA was still up. Free cash flow, very importantly, was quite strong. Compare that to the fall in free cash flow on A2 Milk. Free cash flow is just the cash actually coming through the business. So you might have a customer that's going to pay you next week or next year compared to a customer that's paid you already. It's growing customer. They grew the customer base, so 136 new customers, and projects with top 5 customers, and we're literally talking, the Googles, the Amazons, the Facebooks here, up 34%. China revenue growth, it's very small for them at the start, but you can see growth coming in that, and that's on a quarter-by-quarter basis, so that's a big opportunity for them going forward. Plenty of cash in the bank, enough certainly for them to feel comfortable to declare a final dividend, again compared to A2 Milk, which didn't declare a dividend. It was up 10% on the previous corresponding period. So they've declared it, they've actually increased their dividend. It's only 50% franked, and that speaks more to the fact that most of their earnings come from overseas. But it's not a fantastic dividend yield at 0.7%. I think with the yield here, the tick in the box is the fact they pay one, the fact that they're comfortable enough to pay one, but it's a growth business. They're not going to give you $1. They're going to take that dollar and reinvest it back in the business and grow your share price by 10 times that amount. So that doesn't bother me at all that the yield is small. It's due to the due to the style of the business. It is a growth business. They did provide EBITDA guidance, and unlike falls in margins and profits like A2 Milk, they're still predicting some really good growth to come through the business over the next 12 months, somewhere between sort of 18 and 28%. So tick the fact they've provided guidance, because many companies haven't done that. because of COVID, and tick the fact it's heading in the right direction. And one of the key quotes I thought from the most recent result, they have said ongoing investment in the platform, including AI-enabled annotation, is improving productivity and further strengthens our competitive position. Okay, so what this means here is the missing link that I mentioned before, the fact that they're spending literally millions, tens of millions on research and development, on getting the computers to do the analysis by themselves. That was the key comment for me in their last results, saying that, hey, we are making some progress. So just kind of hang in there, shareholders. You're going to see something good coming from that in the not too distant future. Okay, looking at the financials, bottom left, top right, in most of those, there is some COVID impact there in free cash flow, but it was still up, so maybe even that's a bit of an aberration there from the Thomson Reuters data. But otherwise, dividends are expected to increase, earnings expected to increase. There's a little pause because of COVID, but it's onwards and upwards as far as the major brokers are concerned, which means that some of the multiples should come down. We talked about an enterprise value to revenue at A2 Milk of just over 3, so this one's just over 2, which is actually starting to look quite good. Price to free cash flow is below 20. I'm looking at sort of a couple of years out here. And PE is around about 20, which I said is high for A2 Milk, just given the type of business it is, but I don't think it's high necessarily for Appen. I think it deserves a higher multiple because of the growth that's in the business. Return on equity is not as good as it was a few years ago, but it's still excellent there in the mid-teens. What do the brokers think about this one more generally? Well, we've got 3 strong buys. So straight away, very different from A2 Milk, isn't it? 3 strong buys, 2 buys, 6 holds, just the 1 sell. So only 1 broker that's a bit cranky with it. The mean target gives us about 35% of upside from its last price at 15.74 with a high target of 16 and a high target of 28 and a low target of 16. So you can actually see at the current price, we're actually below the lowest target of any broker, which is kind of interesting. But as I said, those target prone to adjustment. But look, let's take that as the brokers, they kind of like it here. They don't think it's too expensive, and they're happy to buy. Having said that, though, the chart is not telling us it's time to buy yet. So we're still in a long-term downtrend. We're still in a short-term downtrend. We've still got lots of black candles. We've still got lower peaks, lower troughs. We are being supported at 15.15, but we're getting pretty close to that even today. And that 15.15, disappointingly, is below that big low from the COVID pandemic there at 15.70. So the fact it broke at that and we're trending back towards it is not fantastic. Let's have a look at the weekly chart on Appen so we can get an idea of what could happen if it does break below that sort of 15.70 level. Look, it is a pretty well-defined zone of support, actually. So anywhere between 14 and I'm going to say about 11, there should be plenty of support down there. So yeah, there's a little bit more potential downside, but probably not a whole lot based upon that weekly chart. And I think that fits quite well with some of my assumptions here on the valuation. Is the company a dog with fleas? No, absolutely not. This is a high quality company. It's not without its challenges, competition, impact of COVID, hence the current price. But it is the leader in the space, and it is a rapidly growing sector. The US economic rebound is the key, I think, to drive short-term growth, but longer term, I think that just the growth of the total addressable market, I think, is enough for me to want to get involved, and therefore justifies growth like stock multiples. So I don't think it's a stock that you think is cheap at 15. I think it's a stock you think is cheap with a PE of 20 or 25 even. So based upon that, and looking at the last price of 15.74, I think it's good value basically here. I think it's already at sort of that good value range. We know it could go a little bit lower on the chart, but it would be great value sort of at 9.30 to 12.40, and then an absolute bargain below 9.30. But I honestly don't think you'll see it there, because if it's a bargain, then everybody would have kind of bought it already. It would take a major shock to get down there. So we're already at sort of that area where I think the buyers are going to start to come in. Is it time to buy now? No, because of the chart. So I need to see the trends at least show signs of beginning to turn to the upside there. Okay, next cab off the rank is Kogan. It's in the consumer discretionary sector. They mainly do online retailing, but there's not a lot Kogan doesn't do these days. You can get your internet connection through Kogan. You can get your health insurance, life insurance, pet insurance through Kogan. You can have your mobile phone on a Kogan plan. You can borrow money from Kogan for a car or even your home, and you can get your power bill from Kogan as well, and that is mainly done through their exclusive brands, for example, Kogan Energy, Kogan Insurance, Kogan Mobile, etc., etc. Another part of the business, very interesting for me, is Kogan Marketplace. And the great thing about Kogan is they've spent all this time and money building this fantastic infrastructure where they sell you stuff. Well, now they're pivoting to become a bit like Amazon, a bit like eBay, where if I have something I'd like to sell, I can use their infrastructure to sell that to other people as well. So I might source some widgets in China for 10 cents each and sell them through the Kogan Marketplace for $1 each. Kogan will obviously has the shop front where people are going anyway. I don't need to set up my own business and attract people. People are going to Kogan. They'll find my product. Kogan will pick the product from their warehouse. This is done mainly by machines now. They've taken the human out of much of this process: picking, packing, sending, delivering. Of course, you still need a person to deliver it, but they have invested a huge amount in their infrastructure to make it as lean and mean as possible. And unlike A2 Milk, their margins as a result are rising. Unlike Appen, which is trying to do that, these guys are ahead of the curve. So that marketplace is I think their key growth segment going forward. Okay, why is the share price down so much? I think it's a brilliant company. It's probably my favourite company out of the four, but why is it performing so poorly? So down, looking at my notes here, 49%. Since their high. Well, more broadly speaking, we've had this huge spike in interest rates, which has caused a re-rating of tech stocks. So we've heard the headlines that tech stocks have had a hard time, interest rates have gone up, stocks with high growth multiples are therefore getting re-rated by the market. So we've seen the PE on Kogan go from 53 times its 1 year forward earnings to around about 27 times. Not a bad thing for us if we're looking to pick up a quality company at a much more reasonable valuation, but this is one of the factors that's impacting it. And then there's some fears that some of the great growth they had through COVID, because we all switched to online sales, may not be able to be repeated going forward. So some of your like-for-like comparisons might not be as fantastic because we return to quote-unquote normal retailing habits. Okay, well, how are they responding to this? Well, there's not a lot they can do about investors re-rating their share price. It's completely out of their hands. Beauty is in the eye of the beholder. In terms of consumers returning to normal habits, well, many would argue that we've seen structural shifts in our spending patterns, that more and more people who didn't know who Kogan was pre-pandemic or didn't trust them pre-pandemic has used them out of necessity and has had a good experience because they're actually really good at what they do. And if you have any problems, they sort them out very, very quickly. So a lot of that spending is going to be sticky. And as a result of that COVID switch, they're now over 3 million in terms of their customers. And I've used that term, their critical mass, in terms of how it feeds back into their ecosystem. And Kogan is an ecosystem now. They've got basically something else you need. You might have gone on there to buy yourself a new TV, but you're getting an email now about a great deal on home insurance, okay, or power, or your mobile plan, and it's just going to feed on itself. And I mentioned this exciting development of marketplace as well. Years of investment in logistics, I talked about that earlier. Logistics and warehousing is paying off in terms of their growing margins. And this was an interesting slide I picked out from their last financial results, which shows the business. And what I love is just how many businesses they have. And most of these are, let's face it, they're technology businesses, or they're white labelling somebody else who's got all the costs and is doing all the hard work. And Kogan is literally just clipping the ticket. And that's very, very exciting. But looking at the size of the market that business is operating in, and has the business achieved greater than 1% of the market share? So the ticks are great, where they've made some great progress. But I like the fact that there's a lot of boxes that haven't been ticked there, and I love the fact that the management put this in to kind of say, hey, watch out, we're going to tick all these boxes. So I think that's quite interesting. Also from the last results, just to demonstrate here some of the amazing growth that is in the business at the moment. The only one which was down was advertising income, but that's probably more COVID related, and it's off such a small base I wouldn't even worry about it at all. But that is staggering, and probably market, apart from your Afterpays and Zips, which, let's face it, they don't make any money anyway. and may never do. This is real growth from a real company. And this was a quote here also from their last results, which I thought was pretty neat. We launched nearly 15 years ago. At that time, we would have been cheering if we'd helped 3,000 customers. Now we're over 3 million customers, and we feel like we're just getting started. I like that sort of talk. Looking at the results in a nutshell, all very good. The only thing that concerns me is free cash flow. There were no notes, and that concerns me a little bit as well when the company doesn't make a note to say, hey, why was free cash flow down so much? So it was minus 23.4 million versus 17.3 previous corresponding period. So that's H1 FY20 and versus 28.2 in H2 FY20. Could be just timing issues. There were some acquisition costs which they pumped through there. I'm going to watch it very closely in the next in the full year result. That is a line I need to see pick up. But otherwise, it was fantastic. And we saw A2 Milk with an 800 basis point decline in margins. Margins here up 450 basis points. Interim dividend, that's just a copy and paste there where it says nil. They did declare a dividend of 16 cents per share. It is fully franked, and the dividend yield is 2.7%. The copy and paste simply from the one before, which was A2 Milk, which didn't declare a dividend. So apologies for copying and pasting that in. They did not provide guidance because they say it is not our policy to do so, but they do give us regular updates, and they said that their January numbers are showing similar growth to the end of December 31. So why would you doubt them, I guess? Bottom left, top rights on all of those except for free cash flow. There's that question mark. So that's the one I'll be watching most closely in their next results, but otherwise fantastic. Valuation metrics, better again on EV to R and some good numbers there. Price to free cash flow is fine. Price to earnings ratio is sort of in the mid-20s. I want to say 27 at the moment for FY21, and then it falls to below 20 in FY23. And I think if you can get any business with this sort of growth on a P of less than 20, it is a bargain. It is a bargain. I'd be happy to pay up to even 30 times for this business for next year's earnings. But at under 20 times FY23 earnings, I think it is cheap there. In terms of what the brokers say on it, sorry guys, and I'll double check those, but I know this is absolutely correct. So a mean target of 20.43 with that gives the stock a 57% upside to that target. Last price at 13.01. 5 estimates. And this should be buy. Okay, so have confirmed that this is actually an average of a buy, which you don't have to take my word for it because 1, 3 and 1 is going to equal a buy. High target of 25, low target of 16.15, so it is actually well below even that low target there. Looking at the technicals, it's not as bad potentially as the first two we looked at, but it doesn't look fantastic. We're still in a short-term downtrend. We're actually in a long-term uptrend. Interesting, isn't it? We're actually still in a long-term uptrend, but you can see it's gone amber, so that is a watch and see. I would need to see this get back above 14.25 before I started to get really excited about it. And if that was the case, it could actually stamp out 11.88 as a low. You may not see it get back there. If we get below 11.88, you've just got to wait and see because it's just getting cheaper and cheaper, and then we've got to wait for the right price pattern before we go out and buy it. Kogan on the weekly chart is still holding up. Where's the long-term support around that $10 level? Will we get there? Who can say? We'll just keep an eye on it and understand what we're getting when we get it. Okay, so conclusion on Kogan. Is it a dog with fleas? Absolutely not. This is one of my favourite stocks on the ASX. It's got growth in spades. It's increasing its margins. It's got a great management team which continue to unlock growth. That growth will probably moderate. They're not going to keep growing at 150% per annum. That's silly. But the growth is still going to be more than enough to justify a higher earnings multiple. It is a competitive space though because they're competing with Amazon, eBay and many others, smaller ones. They're in space. I'm thinking Catch.com is another one, and there's a few others out there. But they're well placed because they do have that critical mass now, and I think they're going to continue to carve out their niche, and the benefits will flow back to shareholders through capital gains and higher dividends down the track. Is it time to buy? Well, no, not yet. So it is a great stock. It's looking quite cheap. We saw before the last two stocks sort of just either getting into their good value range or above their good value range. This one is very much inside its good value range, and you can see where I think it's going to be great value and where it's going to be a bargain. So that long-term support around 10, I'd have a standing buy order there, because if it got down there, it would be an absolute bargain. Okay, I'm going to whiz through Treasury Wine Estates because we're so far behind on time. We know what they do. The name, what they do is in the title of their name, obviously, and there's a bunch of their brands down there. We probably also know why their share price is down about 48% from its highs. China applied a 175.6% tariff. They called it something else, but let's call it a tariff, and it's going to be in place for at least 5 years. In the opinion of China, Australian wine exporters have been dumping wine into the Chinese market, and that is the penalty accordingly. Chinese wine sales were about $500 million a year business for Treasury Wine Estates. This is going to make them very uncompetitive, and most analysts have gone so far as to pencil in zero of those sales going forward as a result of that tariff. COVID obviously had an impact as well, but not as big as the first one. The company has itself said that China demand is going to be extremely limited going forward. And as I said, many analysts have just drawn a line through that going forward. It was about $161 million of their EBITDA. They need to find another way to get that back. The other problem with it's not just the lower earnings, it's the lower margins, because that was their highest margin business. So it wasn't just a growing business, it was a juicy business as well. So you look at the margins in Asia more broadly, but it was basically China anyway, 39.5% margins versus 13% in the USA and 22% in Australia. But as a plus, going forward, they are tweaking their country of origin pipeline. So that's what COO stands for. So they're saying, okay, well, the Chinese have a problem with Australian wine coming into China, but they don't have a problem yet with French or American wine coming to China. So we've got Penfolds. Why don't we just grow the grapes in France? Or why don't we just grow the grapes in the USA? Still make it a premium product, whack the label on it that the Chinese like, and send it from France into China. So that's a possibility, but we're looking at least 2 to 3 years to make that happen. It's not something you can just switch over overnight. There's a response plan in place. They're looking to reallocate the vintages that were earmarked for China to other Asian destinations, of which have shown growth anyway: Australia, Europe, Middle East, and USA. But you can't plug a hole like China very quickly. To try and assist, they're looking for cost savings in the business, and they are on track to deliver those $50 million worth of cost savings per annum. They've had a big restructure in the way they sort of manage the business internally, and looking to divest non-core businesses to raise some cash, pay down some debt, which they've actually paid down quite a bit of debt over the last financial year. So you can see they've paid down about 28% of debt. So, sort of leaner and meaner, which is always a good thing. It hasn't helped them avoid an 8% fall in revenue, which I think is actually not bad, but we're still early days of the impact, so some of the future numbers might not be as good. Fall in EBITDA. Cash flows were still very strong. So yes, cash receipts were lower, but the impact of those lower costs, interest payments from lower debt, is having a positive impact on cash flow. So that's a big tick there as well. There were some one-off restructuring costs which have been recognised and put behind us, so that's a good thing. Interim dividend was paid. It was down 25%, but at least it was paid, 15 cents per share. It was fully franked, which still gives it a dividend yield, 1 year forward yield of about 3.5%, which I think is quite good. Year 21 guidance, no specific guidance, just a lot of we're working hard to fix things, but they have said that H2 is roughly going to be in line with H1, which actually I think is probably a good thing. And, the comment from the company, a key comment there: while we expect disruptions to continue across a number of our sales channels through the remainder of fiscal 2021, the fundamentals of our diversified global business remain strong. One of the problems I have with Treasury Wine Estate, and it's unlike the first ones we've looked at, which had charts here which were kind of bottom left, top right, and if they weren't completely bottom left, top right, there was a little dip there for COVID and expecting to do so. Treasury Wine Estates, it's more of a flat sort of business. They have good years, they have bad years, because it's an agricultural company, and you have to keep that in mind. So straight away, this is not exactly a business that I would naturally be pulled towards anyway, as somebody who's more of a growth investor. In terms of their valuation metrics, not great there, so not looking too cheap on enterprise value to revenue. Price to free cash flow is not great, not terrible. Price to earnings ratio, really for this sort of a company, I think it's quite high. Looking at, I'll give you the number here. So 20 times FY23 earnings, but about 26 times next year's earnings. Return on equity is, high single digits, which is not bad, not fantastic. So hard to see the growth and hard to see the value, which might give an indication of where I'm sitting on this one. What do the brokers think about it? We've got an average rating of a hold, and I think that actually does make sense. Maybe I copy and pasted the Kogan one out of here. One sell, one strong sell, so a couple of brokers pretty cranky with it. But otherwise, there are still some brokers out there keeping the faith. That's encouraging. The mean target, not that fantastic though, only 11.04, which gives it the least upside, according to the brokers, of any of the stocks we've looked at today. Off 13 estimates, a high target of 14.80, a low target of 9.30, so a little bit sort of above that. Standard deviation of $1.56. Looking at the chart, it's actually got the best chart out of the 4 stocks we've seen. So in my opinion, probably the least growth going forward and the most expensive, but the broker's not as bad on it, I guess, and that's supporting the price. I wouldn't say it's a great looking chart though. Whilst it's the least worst, I don't think that's a tick of approval. The short-term trend is down. The long-term trend is actually still down, but in sort of this intermediate phase. The fact it's breaking through 1020 could see us come into sort of that 9 level there. We don't need to zoom out to the weekly because the long-term support levels are very clear on the chart. And I think where I've drawn those lines are pretty much giving you some indication of where the value could be. So good value is just below where we are. So it's sort of getting close to where it's going to be good value, but better value, I think, below 750, and it would be a bargain below 5. Such is the disappointment from me in terms of the growth in it and what I think you should be paying for that growth. And my summary is, look, is it a dog with fleas? No, it's not a dog with fleas. It's not that terrible. It's just not fantastic. I think it's hard to keep the faith in the short term because of the magnitude of the challenge ahead of them, re-pivoting away from China. It was such a big part of their business, and the likely time it will take to implement some of those solutions. Only modest growth in the rest of the business makes it tough to find a great deal of near-term value. Watch for possible corporate action. I think maybe that's why it's probably trading a bit above where it is actually really good value, because you could actually see a big European competitor. There's been some rumours around, a particular one coming in to buy this one, and a price of $14 was mooted. That was about 2 months ago. We haven't heard anything since, so make of that what you will. Okay, that's it for me today. 4 stocks. Could we buy any of them right now? No, interestingly. All 4, can we buy them now? Answers were no. None of them are dogs with fleas though, and some of them look quite interesting. I think it's just a matter of waiting until they get to where they're either good or great value, and we see a technical pattern that would indicate that others are thinking the same as we are right now. You can catch all of our other market news and updates in our market news section of the website. You can follow me or the Think Market handles, if you like, on Twitter. In terms of upcoming events next week, you can bring your portfolio to the table in Ask the Experts. Throw me a stock you're interested in and I'll do some fundamental and technical analysis on the spot for you. We will have our fundamental analysis refresher coming up on the 5th of May, and that's really re-explained to you how to interpret some of those fundamental data that we talked about in today's presentation. And then continuing our 3 series, we'll do 3 stocks under 30 cents on the 19th of May. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before trading with us, make sure you read this disclaimer carefully and give us a call if you have any questions at all. Thanks for joining me today. All the best for your trading. Until we catch up again. Bye-bye for now.